There was a period in my trading when I thought divergence was the most powerful secret in the world. RSI divergence, MACD divergence, whatever indicator, if it showed divergence, I jumped in. And sometimes it worked, but many times the market just kept pushing and I got haunted like I didn't even exist. One day something strange happened. I was in a EURUSD trade because I saw clear bullish divergence. But when I checked GBPUSD, which usually moves exactly like EURUSD, it showed me no divergence at all. Price was falling cleanly. 10 minutes later, EURUSD broke the level and stopped me out perfectly. That moment changed everything for me. I realized divergence alone is not enough, but divergence plus correlation is a weapon. Before we jump into the strategy, we need to understand one thing clearly. What is correlation divergence? Correlation divergence is when one market shows divergence, but another closely correlated market does not. Why is this powerful? Because when two assets usually move together, like EURUSD and GBPUSD or NASDAQ and S&P 500, their internal strength should match. If one pair shows weakness while the other shows strength, it means something is not real. One side is lying, and most of the time, the side showing divergence is the one that's being manipulated. So, correlation divergence help you avoid fake signals or avoid liquidity hunts and find the true direction of the market. Let's break this down step by step. The concept is simple. When you see divergence on your chart, don't enter immediately. Instead, check the correlated symbol. If both charts confirm the same story, the divergence is trustworthy. If the second chart does not confirm the divergence, it means your chart is giving you a trap. Here's the logic. If two markets move together 85 to 95% of the time, but suddenly one shows weakness while the other doesn't, it's a sign that big players are manipulating one of them to sweep liquidity. So the rule becomes only trust divergence when your correlated chart agrees. If the correlated chart disagrees, stay out or look for an entry in the direction of the stronger symbol. Not every pay has strong correlation. Here are some of the most reliable ones. Forex correlations. EURUSD and GBPUSD. They have a very strong positive correlation. EURUSD and XAUUSD or gold. Gold often moves with EURUSD when USD is weak. USD JPY and US 30 or Dow Jones both react strongly to risk sentiment. And AUDUSD and NZDUSD almost twins. In indices, we can name NASDAQ 100 and S&P 500, Dow Jones and S&P 500, and DAX with Euro Stocks 50. In crypto market, the best is Bitcoin with Ethereum or Bitcoin with some stable coins. When you see divergence on one symbol but not on its correlated partner, you know something is wrong. Always remember, smart money rarely manipulates all correlated assets at the same time. They manipulate only one chart to sweep liquidity. Correlation divergence is not a typical strategy, it's a filter. It protects you from traps, false signals, and manipulation. If you use divergence alone, you will always be hunted. But if you combine divergence with correlation at key levels, you finally see which side of the market is real. So if you enjoyed this video, please like, subscribe to our channel, and leave a comment about correlation. Thank you for watching this video. Remember, think smart and trade fast.